So I want you to think about this for a second. How does a country that is just like sitting on world-class reserves of gold, copper, natural gas, how does it actually get poorer every single time it pulls a ton of ore out of the ground?
Well, it completely defies standard economic intuition, right?
Yeah.
But I mean, that's only if you're looking at the wrong ledger. If you look at the real accounting, the wealth isn't actually being generated, it's just being moved.
Yeah, and often moved right out of the country. So welcome to the deep dive. We've got a really fascinating, honestly incredibly dense data set in front of us today looking at Papua New Guinea's resource endowment.
It is a massive report, yeah.
It really is. And the central paradox of this whole analysis, the hook, that is, I think, going to completely change how you look at global economics is
Yeah.
this single wild metric from 2015.
Right, the adjusted net savings rate.
Exactly. That year, Papua New Guinea's adjusted net savings rate, or ANS, it didn't just stall out. It actually fell to a negative 1.64%.
Which is, it's the mathematical proof of the paradox right there.
Yeah, a negative rate.
Exactly. Because when we look at standard macroeconomic headlines, we are heavily conditioned to see extraction as pure growth. I mean, you dig up $1 billion worth of copper, you sell it, and boom, the national balance sheet seemingly expands by $1 billion.
Right, you think, hey, we're $1 billion richer today.
Exactly. But adjusted net savings, or ANS, it forces us to look at the actual mechanism of asset liquidation. So when you factor in the depletion of those, finite resources, plus the environmental degradation left behind, the actual sovereign wealth of PNG was contracting.
Shrinking.
Yes, shrinking.
It's so crazy. It's honestly exactly like a major corporation just selling off its proprietary manufacturing equipment to pay a special one-time cash dividend to shareholders.
Oh, that's a really good way to put it.
Right. Like the quarterly profits look absolutely incredible to Wall Street, but the company itself is just being fundamentally hollowed out from the inside.
That is the perfect analogy. You are literally liquidating your equity and disguising it as revenue. And I think to understand the sheer scale of this illusion in Papua New Guinea, we really have to establish the baseline footprint of the country for you.
Yeah, let's lay the groundwork. How big are we talking?
So as of 2021, we're looking at a population of roughly 10.14 million people.
Okay, so a fairly substantial nation.
Definitely. And by 2022, their traditional gross domestic product, their GDP, sat at about $31.6 billion.
$31.6 billion. I mean, that is a highly substantial economic engine.
It is, but here's the catch. When you dive into the historical growth trends of that $31.6 billion, you don't see that steady compounding growth curve that usually indicates a healthy, diversified economy.
Right, the kind you'd want for your own retirement portfolio.
Exactly. Instead, you see this violent macroeconomic whiplash.
Yeah.
Like the standout anomaly in the data we're looking at is 2014. In that single year, PNG experienced a staggering GDP growth spike of roughly 15%.
15% in 1 year. That's insane.
A 15% growth rate is an absolute economic shockwave.
Yeah, I mean, most developed nations are thrilled with like 2 or 3%.
Right. But we really have to examine the causality there, because that 15%, that wasn't some sudden renaissance in domestic manufacturing or a breakthrough in, tech innovation.
No, of course not.
That 2014 spike was intimately tied to the life cycle of mega extraction projects. Specifically, massive liquefied natural gas LNG operations finally coming online, combined with these massive swings in global commodity prices.
And this really introduces that concept of resource rents, right? Which absolutely dominates the structural reality of PNG. Like, looking at the report, the data shows that back in 1992, mineral rents hit a historic high of 27.6% of the entire GDP.
Which is just a massive slice of the pie.
Think about that. Over a quarter of the entire national economy was pure mineral profit. And then right around that 2014 boom you mentioned, oil rents saw this massive parallel rebound.
Yeah, and the vulnerability there is just profound. I mean, when a nation's budget is essentially tethered to the daily whims of the London Metal Exchange or, global energy markets, it ceases to be an independent economy in a lot of ways.
It's like you're not steering your own ship anymore.
Exactly. It becomes a geopolitical shock absorber. So if global supply chains bottleneck and copper prices surge, the national treasury just overflows. Everyone is celebrating.
Champagne for everyone.
Right. But when those prices eventually correct downward, or, when a major mature mine just naturally runs out of ore and shuts down the capital, dries up literally overnight.
Which perfectly explains the aftermath of that 2014 spike. because following that 15% high, the data charts this severe, grinding economic slowdown. It stretched from 2015 all the way through 2020.
Yeah, it is a textbook boom and bust cycle.
And this brings us right back to the deception of traditional GDP, right? GDP tells you the cash flow of the boom, but it completely ignores the structural damage of the bust. And honestly, more importantly, it ignores what is being permanently lost.
Absolutely. And to visualize that loss, the analysts in our source material utilize this highly specific financial model known as the waterfall chart.
Yes, I love this chart. It's so revealing.
It really is. If you truly want to grasp the mechanics of resource dependency, this chart is indispensable. It maps the exact journey from the illusion of gross wealth down to the harsh reality of net depletion.
So let's trace that waterfall for the listener. Let's walk them through it. At the very top, you have this wide, roaring river of what they call national gross savings.
Right, the big top-line number.
Exactly. This is the highly inflated number driven by the export of those raw ores and metals. But then, as you move left to right on the chart, the capital starts cascading downward over a series of cliffs, and these represent the hidden costs. The first subtraction, the first drop-off, is fixed capital consumption.
Yeah, and we really shouldn't gloss over what that actually entails in the real world.
Hmm.
Fixed capital consumption, it's the inevitable degradation of the country's physical infrastructure.
Wear and tear, essentially.
Immense wear and tear. In an extraction economy, the physical toll is unbelievable. We are talking about heavy haul roads just being completely pulverized by mining trucks day in and day out.
Oh, sure. Those massive building-sized dump trucks.
Exactly. Plus, deep water port facilities rusting and degrading in the tropical climate, and the immense cost of maintaining power grids in this highly rugged mountainous terrain. You are bleeding capital just to keep the existing machinery running.
So the river of wealth narrows significantly right off the bat, but then the next drop is the truly catastrophic one. We subtract mineral depletion.
This right here is the absolute core of the adjusted net savings philosophy.
Yeah, explain this because it's so critical.
So every single ounce of gold, silver, and copper that is pulled from the highlands and shipped overseas, that is an asset that is permanently struck from the nation's inventory.
It's just gone.
It is gone forever. It took literally millions of years of geologic pressure to form. Subtracting this from the gross savings, it fundamentally shifts the entire math from income generation to asset liquidation.
Because you aren't growing anything, you're just emptying the vault.
Exact.
And the liquidation continues with the third cliff on the chart where we subtract net forest depletion, which, it operates on the exact same logic.
Yeah, it's the biological version of the same problem.
Right. If you are clear-cutting ancient primary timber faster than the natural ecosystem can regenerate it, you aren't harvesting. You are mining the forest. You are literally converting a self-sustaining long-term biological asset into a one-time cash payout.
So after you subtract the decaying infrastructure and the emptied mineral veins and the depleted forests, that roaring river of gross savings has been reduced to an absolute trickle.
It's depressing to look at.
It is. However, the waterfall chart does include one crucial addition at the very bottom. You get to add back education expenditure.
Right, the only green bar on the negative side of the chart. And that's because education, unlike a mining truck, isn't a depreciating physical asset.
Yeah, it's an appreciating investment.
It's an investment in human capital. It is literally the only metric in this entire calculation that represents the building of future wealth-generating capacity.
Exactly. You synthesize the gross savings, you subtract the multi-tiered depletion of natural and physical capital, you add the human capital investment back in, and finally you arrive at the adjusted net savings.
The moment of truth.
And as we established right at the top of the deep dive, when you ran this honest accounting for P&G in 2015, the bottom of the waterfall was completely dry.
Negative 1.64%.
The ledger was completely in the red.
I mean, the structural hollowing out of the country is just undeniable when you look at it through that specific lens. And the trade data from the report reinforces this reality to a staggering degree. Like in 2022, trade volume accounted for an astronomical 97.3% of Papua New Guinea's GDP.
I know, that figure is almost difficult to conceptualize, honestly.
It sounds like a typo.
It really does.
Mm-hmm.
But when trade volume approaches nearly 100% of your GDP, your domestic economy is essentially just a pass-through entity. It's a conveyor belt. And the composition of that trade is where what economists call the trade trap really closes its jaws.
Because they aren't exporting a diverse array of goods.
Not at all. Ores and metals consistently dominate the export landscape. comprising anywhere from 40 to 70% of all goods exported year over year.
Which is the ultimate danger of lacking economic diversification. And it really requires us to think about the global value chain for a minute.
Yeah, let's talk about the value chain.
If P&G is just digging up raw copper and shipping it straight to industrial hubs in Asia or Europe, they are entirely missing out on the value-added processes. Like, the real compounding wealth isn't in the dirt.
No, the dirt is cheap.
Exactly. The wealth is in refining the ore, engineering the circuitry, and manufacturing the high-tech goods. P&G is stuck providing the raw ingredients while the rest of the world basically bakes the cake and keeps the profits.
The economic mechanics of this are just ruthless. Yeah. Because when you export raw earth, your profit margins are entirely dictated by global commodity buyers. You have zero pricing power.
You just take what they offer.
Yeah, you are trapped at the absolute lowest tier of the economic hierarchy, trading your finite geological inheritance for fleeting cash flow.
Which naturally leads to a really glaring logistical question, I think.
What's that?
Well, if you are running an economy where 97.3% of the GDP is tied to trade, and the vast majority of that is just raw metals and ores, well, you don't need 10 million citizens to run a few highly mechanized multinational megamines.
No, you definitely don't.
You need some heavy machinery, some specialized foreign engineers, and a deep water port. So the question is, what is the rest of the population actually doing every day to survive?
And that is the pivotal question. It bridges the macroeconomics with the actual human reality on the ground. Because to answer it, we really have to recognize that there are effectively two Papua New Guineas.
Two parallel nations, almost.
Exactly. There is the highly capitalized, export-driven mining enclave, which generates the cash. And then there is the massive, employment-sustaining agricultural sector.
And the data on this split is incredibly stark. Like in 2022, agriculture, forestry, and fishing accounted for roughly 32.2% of the GDP.
So about a third of the national wealth.
Right. Yet, it absorbs the overwhelming majority of the actual human workforce.
But the tragedy lies in the productivity of that workforce. The analysts measured the per capita value added in agriculture, essentially, the raw economic output of a single farmer working the land.
And the numbers are not good.
They are deeply concerning. Measured in 2015 constant dollars, agricultural productivity has completely stagnated. It just hovers between $3,400 and $5,700.
That's per year.
Per year, yes.
Contrast that immediately with the industrial sector. The mining and drilling operations that generate the lion's share of all that export wealth, they employ a mere 7.7% of the workforce.
It is an incredibly skewed distribution of capital versus labor.
Completely upside down.
And this skewed reality brings us to one of the most revealing, almost contradictory data anomalies in the entire report.
Oh, I know exactly what you're going to bring up. The employment data.
Yes. It has to do with how employment is officially measured, particularly along gender lines. The formal data reports male agricultural employment at roughly 35%. But it reports female agricultural employment at a microscopic 2%.
2%. I have to say, when I first saw that 2% figure in the source material, it literally stopped me cold.
Because it makes no intuitive sense.
None. Anyone who has studied developing economies, or frankly, anyone who understands the sociological backbone of rural highland communities, knows that women are the absolute engine of subsistence farming.
They are the foundation.
They manage the crops, they tend the livestock, they secure the daily caloric intake for the entire family. So how on earth can the official data claim only 2% of women are in agriculture?
It reveals the profound bias inherent in traditional macroeconomic tracking, that 2% figure. It is almost certainly only capturing formal corporate payrolls.
Right. The people with W-2s, essentially.
Exactly. It is counting the women who clock into a massive commercial palm oil plantation and receive a formal taxable wage.
Leaving the vast majority of women completely invisible to the state.
Entirely off the books.
And the report actually confirms this invisibility just a few lines down in the data when it switches to measuring what they call vulnerable employment.
Yes, the vulnerable employment metric is crucial here.
The data shows that vulnerable employment sits at roughly 66% for men, but for women, it's a staggering 79.7%.
Yeah. When you synthesize those two conflicting data points, the reality on the ground comes into incredibly sharp focus.
Almost 80% of women, and when I see the term vulnerable employment, I don't just see a lack of a corporate 401k or paid time off.
No, it's much more severe than that.
Right. I see an account worker or an unpaid family laborer operating completely outside the bounds of any legal protections. These are women running informal subsistence operations, selling surplus yams or taro by the side of a dirt road.
Exactly. It's a day-to-day survival economy.
And it means that if a highland frost hits or a localized drought occurs, their income doesn't just dip a little, it drops to absolute zero.
Because there is no buffer.
None. There is no social safety net, no crop insurance, no formal credit line at a bank to bridge the gap. That is the daily reality for essentially 8 out of 10 women in the country.
And the systemic danger of this statistical invisibility, it really cannot be overstated.
How so?
Because economic policy is dictated by data. If the formal spreadsheets in the Capitol tell the Ministry of Agriculture that only 2% of women are farming, then agricultural modernization funds, new drought-resistant seed programs, mechanization subsidies, they are not going to be directed toward women.
Oh, wow. Because the government doesn't even know they're out there farming.
Exactly. You cannot systematically invest in a demographic that your macro data absolutely refuses to see.
Which is just the perfect segue into the broader crisis of investment in the country. Because if the institutional machinery fails to see its most crucial workers, it completely fails to build its human capital.
And human capital is everything.
It is. And when we look at the demographic reality of PNG right now, that failure is accelerating toward a massive breaking point.
Yeah, the demographic profile of Papua New Guinea is deeply characteristic of a nation in transition. It possesses a classic young population pyramid.
Meaning a very wide base of kids.
Right. In 2022, 33.7% of the entire population was aged 0 to 14.
Over a third of the country hasn't even hit high school age yet. That is a massive youth population.
It is, and it creates an immense structural pressure known in economics as a dependency burden. In fact, the data highlights that the young age dependency ratio is sitting at roughly 58.6%.
Meaning what, exactly? Break that down for us.
Yeah. It means you have a relatively narrow band of working-age adults who must generate enough daily caloric output, shelter, and overall economic velocity to support a massive, non-producing base of dependents.
Now, in the realm of development economics, we often hear this buzzword, the demographic dividend.
Ah, yes. The golden ticket.
Right, the idea that a massive youth bulge is this coiled spring of potential energy. If all those kids hit working age at the exact moment the economy industrializes, you get an unstoppable economic boom.
Yeah.
Look at the Asian tigers in the late 20th century, right?
That is a highly optimistic model, yes. But the demographic dividend is entirely conditional.
It doesn't just happen automatically.
Not at all. It requires that the youth bulge is highly educated, metabolically healthy, and entering a labor market with a surplus of formal jobs.
Right.
If those conditions are not met, if you have millions of young people reaching adulthood without basic literacy, without technical skills, and without realistic employment prospects, that demographic dividend immediately inverts into a demographic bomb.
Oh.
Yes. It becomes a recipe for severe social instability and deeply entrenched generational poverty.
And when we look at the specific education data in the report, it strongly suggests PNG is severely at risk of that inversion right now.
The education metrics are really tough to look at.
They are. The attrition rates in the school system are just alarming. The retention rate drops to roughly 65% by grade 5.
So a third of the kids are gone by 5th grade.
Gone. And by the final year of primary education, it falls to about 56%. Nearly half the children in the country are failing to complete a basic primary education.
Furthermore, the historical deficit in education has created this massive gender disparity in foundational skills. The data indicates that adult literacy for men has actually reached 90.5%, which is progress.
Okay, that's decent.
However, for adult women, the literacy rate plummets to 61.5%.
So 4 out of 10 adult women literally cannot read or write. If we connect this back to the vulnerable employment crisis we were just discussing, the mechanism of poverty becomes brutally physically clear. If a woman is illiterate, she is permanently structurally locked out of the formal wage-paying economy.
She can't even get her foot in the door.
Exactly. She cannot sign a commercial contract, she cannot navigate a bank loan for basic agricultural equipment, and she cannot access government services efficiently. Her only recourse is that invisible, highly volatile, informal farming sector.
It is a self-replicating cycle of marginalization.
Completely.
But while the educational data points to a crisis of potential, the public health data in this report points to a crisis of immediate physical survival. The health metrics are perhaps the starkest indictment of the disconnect between massive resource wealth and ground-level human welfare.
Yeah, we need to pause here and truly unpack this next data point because it is heavy.
It's devastating.
The report details the maternal mortality rate, citing a lifetime risk of 1 in 17 for dying from pregnancy-related causes.
1 in 17.
1 in 17. I want you, listening right now, to really process the gravity of that ratio. This isn't just a clinical metric on a spreadsheet.
No, it represents an immense human toll.
In a nation of 10 million people, a 1 in 17 risk means that human tragedy is just ubiquitous. It means that every single village, every extended Highland clan, every neighborhood in the capital knows a family that has been totally shattered by a maternal death. It is an ambient, persistent trauma hanging over the entire country.
It really is a devastating reality, and it reflects a severe breakdown in basic healthcare delivery. And unfortunately, that breakdown extends to pediatric care as well.
Yeah, what are the numbers there?
The under-5 child mortality rate is documented at a tragic 40 to 60 per 1,000 live births.
That is painfully high.
And additionally, the analysts note that the incidence of infectious diseases, particularly tuberculosis, is actively rising.
TB is coming back.
It's rising, yes. And TB is a highly communicative disease that thrives in environments defined by nutritional deficits, dense living conditions, and an absolute absence of sustained clinical intervention.
So let's tie this all back to the core economic thesis of our deep dive. Remember the waterfall chart from the beginning.
Right, the net savings.
We established that the only factor adding water back into the pool of national wealth was education expenditure representing human capital. Yet, when we look at a 56% primary school retention rate, a 61.5% female literacy rate, and a 1 in 17 maternal mortality risk, we see that the human capital isn't just stagnating, it is actively eroding.
It's crumbling.
The natural capitals, the gold, the copper, the ancient forest is being irrevocably liquidated, but the social capital required to replace it is simply not being built.
Which forces a highly uncomfortable economic realization for policymakers. When the easily accessible ore bodies are finally exhausted, what remains?
Just an empty hole in the ground.
Exactly. If the population has not been educated, modernized, and protected by basic public health infrastructure, there is no foundation whatsoever for a post-mining economy. The wealth will have simply bypassed the people completely.
Which leads us to, really, the most urgent question of this entire analysis.
Where is the friction?
Yes. Where is the friction? If the GDP is $31.6 billion and massive megamines are pumping billions in resource rents into the national treasury, why isn't that capital manifesting as paved roads and rural clinics and cellular towers?
Why isn't it reaching the ground?
Why can't a pregnant woman in the Highlands access an emergency medevac funded by copper money? To understand the failure of delivery, we really have to examine the physical and institutional infrastructure of the country.
And the report is highly methodical in mapping these systemic bottlenecks out. Let's begin with physical connectivity, specifically the digital divide.
The internet.
Yes. In the context of the 21st century global economy, internet access is no longer a luxury consumer good.
No, it's not Netflix. It's a utility.
It is fundamental infrastructure, totally equivalent to a paved highway or a stable electrical grid. It is how markets coordinate prices, how modern education is distributed, and how essential government services are accessed.
And yet, the data for 2023 shows that only about 24% of the PNG population use the internet.
24%.
3/4 of the entire country is completely dark. They are entirely unplugged from the digital economy.
But the nuance in the telecommunications data is actually even more perplexing than that.
The mobile phone numbers.
Yes. The analysts track mobile phone subscriptions, noting a significant spike shortly after 2015, where subscriptions hit roughly 5 million.
Okay, so half the country had a phone.
Roughly, yes. However, by 2022, that number had astonishingly contracted, falling back down to just 3.5 million.
That is a massive anomaly. Like, global trends dictate that mobile adoption really only goes one way up.
Right. People don't usually give up their phones.
Never. Why would 1.5 million people suddenly abandon their mobile subscriptions over a 7-year period?
Well, the report provides the raw data, rather than a complete sociological diagnosis. But we can easily synthesize the macroeconomic forces we've already discussed today.
Let's do it.
First, remember the GDP whiplash. Following that 2014 high, the economy entered a severe multi-year contraction.
The bust phase.
Exactly. When a resource-dependent economy stalls, inflation heavily impacts imported goods, and the kina, which is the local currency, loses purchasing power.
Right.
So for a subsistence farmer operating in the vulnerable employment sector, discretionary income just evaporates. Buying prepaid mobile minutes simply becomes an impossible luxury. They have to buy food instead.
Wow. It's also a matter of physical geography too, right?
Absolutely.
Because Papua New Guinea has some of the most rugged, isolated, mountainous terrain on the entire planet, maintaining cellular tower infrastructure up in the highlands, where you literally require diesel generators flown in by helicopter because there are no roads that is astronomically expensive.
It's a logistical nightmare.
And if the telecommunications companies aren't seeing a return on that investment because the rural population is impoverished and can't buy minutes, they just stop maintaining the towers. The signal degrades, the hardware rusts in the jungle, and the network literally shrinks.
Exactly. It is a compounding infrastructural failure. But the physical friction, the rusting towers and unpaved roads, is only half the story.
Right, we have to talk about the institutional friction.
The report also deeply examines the systems that actually govern the allocation of capital. To do this, they utilize the Worldwide Governance Indicators, or WGI.
Now, I want to pause here. It is crucial to state for you listening that we are looking at these WGI metrics neutrally, strictly as analytical tools provided by the global economic community to measure structural capacity.
Right, this isn't about politics.
Exactly. We aren't interested in political finger-pointing or taking sides regarding specific local administrations, but the data itself is undeniable.
The numbers are what they are.
The WGI places P&G in the lowest tiers across several critical dimensions. For control of corruption, the nation sits at the 29th percentile.
Out of 100.
Regulatory quality registers at a mere 27 out of 100. And government effectiveness scores a 15.9 out of 100.
And these numbers, they essentially define the concept of administrative friction. When government effectiveness is at a 15.9, it tells you that the bureaucratic machinery required to convert sovereign wealth into public welfare is just profoundly compromised.
I always think of it like an electrical grid suffering from a massive voltage drop.
Ooh, explain that.
So imagine the power plant, which is the megamine, is generating incredible wattage. The treasury is theoretically full of energy, but the transmission lines, the regional governments, the procurement ministries, the logistics departments, they are so degraded and inefficient that by the time the current actually reaches a rural clinic in a remote province, there isn't even enough voltage left to turn on a light bulb.
Let alone staff a surgical theater or stock a pharmacy.
Exactly. The power is lost in transmission.
Voltage drop is an excellent mechanism-driven analogy. The capital exists at the source, but the institutional grid is incapable of transmitting it without immense systemic loss.
It just leaks out.
It does. And the data on social safety nets confirms this complete failure of transmission. The report highlights that formal social insurance coverage reaches only about 1.0% of the total population.
1%. If you fall out of the incredibly narrow formal economy, the state mechanism designed to catch you is basically a ghost. It doesn't exist for 99% of the country.
And we must add one final layer to this systemic friction, the environmental debt.
Ah, right.
We touched on forest depletion earlier in the waterfall chart, but the specific ecological metrics in the report paint a much broader picture of degradation.
Because the extraction of wealth isn't just an accounting trick on a spreadsheet. It leaves permanent physical scars on the earth.
Precisely. The data shows highly volatile greenhouse gas emissions, which the analysts directly link to rapid land use changes.
Which means what, practically?
This means aggressive deforestation and the clearing of land for large-scale commercial agriculture, which itself is cited as a major CO2 emitter.
And it goes way beyond just atmospheric carbon, too. The report specifically notes that roughly 100 bird species are currently classified as threatened.
Yes, the biodiversity loss.
In a nation that is globally revered for its hyperdiverse, pristine, and entirely unique ecosystems, that loss of biodiversity is an irreplaceable ecological debt. I mean, you literally cannot buy back an extinct species with copper royalties.
No amount of money brings a species back.
Nah.
So we really have a convergence of crises here.
The perfect storm.
The extraction liquidates the natural capital, leaving an ecological debt. The administrative friction prevents the resulting financial capital from ever reaching the population. And the severe lack of investment leaves the human capital trapped in vulnerable, low-yield subsistence labor.
I mean, if we stop the analysis right here, the outlook is just incredibly grim.
It's very bleak.
We have a negative adjusted net savings rate, we have violent GDP volatility, we have an invisible workforce of vulnerable women, an uneducated youth bulge, devastating mortality rates, and an institutional grid suffering from massive voltage drops. It feels like an unsolvable equation.
It does feel that way.
But, and this is crucial, the analysts who compiled this report do not end on a note of despair. They actually map out a highly specific, three-pillared architectural blueprint for survival and transition.
Right, moving from diagnosis to actual prescription, the report outlines what they call a 2030 sustainable vision.
A roadmap out of the trap.
And the core requirement of this vision is a total systemic rewiring of the national economic engine.
Let's unpack the three pillars of this blueprint because they really offer a masterclass in how a developing nation can theoretically break the resource curse.
Okay, let's start with Pillar 1. It is termed resource fundization.
Yeah, I know that sounds like a piece of dry bureaucratic jargon.
It does, but resource fundization is perhaps the most critical macroeconomic pivot a country like PNG could make.
How does it work?
It dictates that the resource rents that massive influx of cash from the LNG pipelines and the gold mines must be strictly legally ring-fenced.
Mocked up.
Yes, it cannot be used to plug daily budget deficits, and it absolutely cannot be absorbed by the administrative friction we discussed.
It has to completely bypass those leaky transmission lines.
Exactly. The entirety of that fund must be legally mandated to convert directly into human capital investment.
Okay, so tying this back.
If we think back to the waterfall chart, the singular goal of Pillar 1 is to aggressively inflate that final addition line. Education expenditure.
Right.
You take the finite, non-renewable rocks out of the earth, and you immediately convert them into infinite renewable human potential. Building schools, training specialized educators, and funding comprehensive healthcare infrastructure to finally end that mortality crisis.
Which is literally the only way to build a workforce capable of executing Pillar 2, which is agricultural modernization.
Exactly. We established earlier that roughly a third of the GDP and the vast majority of the human population are anchored to agriculture.
But the per capita value added is completely stagnant at under $6,000 a year.
Right. So Pillar 2 is the systematic effort to raise that unit labor value.
It is about ending the invisibility of that 80% of women in vulnerable employment. You don't just recognize them on a spreadsheet, you actively equip them.
You give them the tools.
Right. You provide high-yield, climate-resistant seed varieties. You build the micro-logistics networks so they can get their crops to regional markets before they rot in the sun.
Yes, the supply chain.
You provide access to microfinance so a family farm can purchase a small tractor instead of relying entirely on manual, back-breaking caloric output. You transition them from pure day-to-day survival subsistence into sustainable, profitable agricultural enterprises.
Because when you raise the economic velocity of the rural farmer, you lift the entire baseline of the nation.
A rising tide lifts all boats.
Exactly. However, neither the resource fundization nor the agricultural modernization can truly take root without the structural reinforcement of Pillar 3.
The big one, governance empowerment.
Right. You have to fix the voltage drop in the institutional grid.
There's no way around it.
It is entirely non-negotiable. Elevating those WGI scores, pushing government effectiveness up from a 15.9, is the absolute prerequisite for the ultimate goal, attracting non-resource foreign direct investment, or FDI.
Because this is how you finally escape the trade trap.
Exactly.
You don't just want foreign companies coming in to dig massive holes in the ground and leave. You want international telecom firms building data centers. You want agricultural tech companies building local processing plants so you can export value-added goods instead of just raw materials.
But legitimate, long-term global capital requires stability.
It hates risk.
It does. A multinational tech firm will not build a facility in a country lacking a transparent regulatory environment, reliable digital infrastructure, and a skilled labor pool. Governance empowerment is about proving to the global market that the structural foundation of the country is solid enough to actually support diversified, complex economic activity.
Looking at these three pillars together, it represents a profound, almost philosophical shift in the actual identity of the nation.
It's a total reinvention.
It is the agonizing but necessary evolution from an extraction-based economy, where you survive by slowly selling off the copper pipes and timber of your own house, to a cultivation-based economy, where you survive by growing the inherent value of your land and your citizens.
It demands a level of long-term, generational thinking that fundamentally rejects the intoxicating short-term adrenaline of the commodity boom and bust cycle.
There is a specific, incredibly powerful phrase in the report's conclusion that I think perfectly encapsulates this entirely new paradigm. It states, wealth shouldn't just be mined, it should be cultivated.
And that is the ultimate paradox resolved right there.
Yeah.
The solution to a crisis caused by mining isn't more mining. And it isn't completely abandoning the mines overnight either.
No, you need the capital.
Right.
Right.
It is utilizing the finite geological lottery beneath the ground to strictly finance the renewable, infinite resources above the ground, the agricultural yield of the soil, and the intellectual capacity of the human mind.
Wow. We have covered an immense amount of ground today. For you listening, we've navigated the deceptive illusion of a 15% GDP spike, and we've walked step by step down the cliffs of the waterfall chart to really understand why an adjusted net savings rate can contract even while the Treasury overflows.
We've dug deep into the data.
We've looked past the macroeconomic spreadsheets to see the invisible, vital labor of female subsistence farmers, and we've confronted the heavy, ambient tragedy of a 1 in 17 maternal mortality risk. We've examined the administrative friction of governance, but we've also seen the clear, actionable architecture of a sustainable 2030 vision.
It is a deeply interconnected system.
Everything touches everything else.
Exactly. You cannot isolate the 24% internet penetration rate from the 61.5% female literacy rate, or the heavy reliance on mineral rents from the rising incidence of tuberculosis. Every single metric is a symptom of how a nation chooses to manage or mismanage its natural endowment.
And as we wrap up this deep dive, we want to leave you with one final, lingering thought to mull over. We've talked extensively about the mechanics of transition, how you must aggressively convert natural capital into human capital before the mines deplete.
The clock is ticking.
But consider the ruthless reality of that timeline. To build the schools, to educate an entire generation of youth, to train the thousands of doctors required to fix the maternal mortality crisis, and to modernize a rugged highland agricultural sector. That is a process that takes a minimum of 20 to 30 years.
At least it takes a full generation.
So what happens if the easily accessible high-grade resources run dry in 15 years? Does the window for turning that finite rock into infinite human potential eventually close forever?
It is a race against time, a race against administrative friction, and ultimately a race against the physical limits of the Earth itself.
The next time you see a financial headline touting a massive new mineral discovery or a record-breaking GDP quarter in a resource-rich developing nation, don't just look at the gross revenue. Look for the structural reality. Look for the waterfall. Look for the adjusted net savings. Because wealth on a balance sheet is an illusion. Wealth is only real if it lasts. Thanks for taking the deep dive with us today.